Hi, everybody, and welcome back to Chapter 21. I might say, as a introduction to this chapter, this perhaps is the most complex of the chapters in the book. So you will want to really pay some close attention to this chapter as we get into standard costing, particularly. There is a lot of new information here, and I want you to do well, of course. All right, let's take a look at this. We're talking about flexible budgets and standard costs. So here we're going to define what standard costs are and explain how that standard cost information is useful. I'm reasonably fresh off my last position where we implemented a standard cost system from scratch in a Fortune 500 company. And that process took about a year and a half to do. And I still have vivid recollections of sitting in my boss's office with this huge whiteboard and thousands of no, maybe not thousands, hundreds of T accounts running through all the different permutations and combinations that the system required. And I guess no one was more surprised than I as how well it worked from day one. So, um, any event, you can probably guess from that story that standard costing is sophisticated, but very helpful, and most sophisticated companies use it. All right, so we're going to then analyze changes in sales from expected amounts, and we're going to prepare flexible budgets and what those budgets represent. Then we're going to start looking at total cost variances. And then as we get into it a little bit more, we'll look at direct materials and direct labor variances. We're going to compute the controllable and volume variances for overhead. And the overhead variances, I believe, are the most complex. And don't forget Appendix 21 Alpha in your reading as well, where we will go through the spending and efficiency variances. And then lastly, we'll prepare our journal entries for those standard costs and then how we account for price and quantity variances. Okay, let's get started. They introduce this subject by preparing flexible budgets and how you interpret flexible budgets in a performance report. It's important to realize that this is sort of an introduction to the standard cost system, which is flexible by definition. All right, let's look at some of the terminology here. We use budgets to control operations, and I think you're pretty clear on that. And we see that the planned objectives are being met. The master budget is based on the predicted level of activity for a budgeted period. Pretty straightforward there. Budget reports simply compare actual results to budgeted results. The fixed budget, sometimes called a static budget, is based on one predicted amount of sales and other activity measures. As that changes, of course, that fixed budget per unit is going to change. A flexible budget, or a variable budget, as it's sometimes called, is based on more than one amount of sales or other activity measurement. Let's look at this for a second. So here we prepared this fixed budget. Here's our sales units, our sales dollars, variable cost, contribution margin, fixed costs, and income. And now, what did we actually do? Well, if we look at the actual results, we sold 40% more than we actually had thought we would. And that, of course, generates some lovely sales. And we got a very nice favorable variance as a result of that. But guess what? It cost us more money to make more sales. And this looks bad for the manufacturing group who've made that and have an $18,000 unfavorable variance to try to explain. But in general, we made more money because we sold more units. Our fixed costs should have been $20,000, but it was a little bit unfavorable at $20,400. So the bottom line was we sold 40% more, and we made $6,000 favorable to budget. But the fixed budget performance is going to compare actual results with the results expected under this fixed budget. Not necessarily very valuable data in some cases. So let's look at that as to why. Here, the purpose of these flexible budgets is it's prepared before the period begins. Therefore, we are going to look at several levels of activity here. And we provide a what-if analysis that includes best case, worst case, something I'm very fond of doing. And then it provides an apples-to-apples comparison, as I think you'll see here in a second. It's prepared after the period ends to help evaluate true performance. Management can then focus on true problems. All right, let's look. So now, here is our flexible budget over here at different levels of performance. And our variable amount per unit is shown here. So our variable costs are $5.20 per unit. Pretty easy to verify. That's the amount. These amounts are going to be equal to the budgeted unit sales price here. And that's pretty straightforward as to how we calculate that budget. We multiply these volumes times this $10 and get these sales. And we do very much the same thing with the costs. Fixed costs, in theory, shouldn't change. So you see that all these fixed amounts are the same no matter what level of activity we have. And so this is our projected income based on those various levels of activity. Okay, I think that's pretty straightforward, right? And they show a nice little graph over here. Here's our fixed costs with a nice level green line, and then our magenta line is the variable costs on top of the fixed cost, and together the two represent our total costs. Okay, let's take a look at a performance report now. In this case, we made 12,000 units. So let's go back. Here's our 12,000 units. And we're going to pick off this level of activity here as our budget. And that's what you see here. This level of activity is our budget. The actual results came in sales a little better than that, but now we have maybe better comparisons. Direct materials a little unfavorable, direct labor a little more unfavorable, and indirect material was favorable and sales commission was favorable. But in total, we were unfavorable with variable costs. Nevertheless, we still made money, $3,200 of contribution margin. Looking at just the fixed costs, depreciation and supervisory salaries were well budgeted and consequently no variances occurred. But our insurance went up by $200 over what we had projected here. So it was $200 favorable. So when the dust all cleared, we were $3,000 favorable for this $5,000 of increased, I should say, based on 12,000 actual results. All right, we good with that? So the favorable sales variances because the average selling price had to be better than $10 a unit. If I multiply 12,000 times 10, I get 120. So if I multiply 12,000 by something a little more than 10, I'm going to get 125,000. Unfavorable total direct materials and direct labor variances occur because our actual costs were greater than expected. We would have to dig in to find out why that is. And then our favorable sales commission variances occurred because the actual sales commission were less than what we expected. Okay, now let's take a look at defining standard costs and explaining how that standard cost information is useful. Standard costs can be used in a flexible budgeting system to enable management to better understand the reasons for those variances. Very important. We set up these standard costs. These are preset costs needed to deliver a product or service under normal conditions. And when they say normal conditions, that's not perfect conditions. That's expected. Good, solid performance, but not perfect. Okay. And then we look at what the expected level of performance is going to be, and then the manufacturers then can use that standard costing for each material, raw material item gets a standard cost, and we have direct labor standards for each product that we make, and overhead costs for each product that we make. Let's take a look at that. All right, so here, when we set these standard costs, we're going to look at the cost necessary based on quantity that we're purchasing and the quality of the materials that we purchase. Key things. They don't say here, but also delivery time. If you crash and burn and don't plan well, don't expect your vendors to give you your best price. So we want to assume good planning. Then direct labor is going to be based maybe on our manufacturing engineering staff coming in and determining how much reasonable direct labor that we would take to make that product. And we would establish our standards that way, including our wage rate. Oops. And then lastly, what resources we expect to consume on a variable basis. So the fixed overhead is pretty easy to calculate. So let's take a look at that. Our standard costs example then is direct material, direct labor, and overhead. So we're using a bat manufactured by ProBat here. This is a baseball bat, I'm assuming. And here it shows how much direct material, lumber, 2.2 pounds, how much it costs, $10 a pound. So we're going to say that that bat is going to cost $22 in direct material cost. We have 2 direct labor hours necessary to manufacture that, and it's $15 per direct labor hour on average, or a total of $30 here. And then our overhead is going to be based on 2 direct labor hours times $5 per direct labor hour as our standard predetermined rate. And that gets us to $10. So our total to manufacture this bat is $62. These standard cost amounts are then used to prepare the manufacturing budgets for the budgeted level of production. Now we want to be able to just, we'll delve into this a little bit more. This is what's called a standard cost card. This looks like a good place for us to stop this video. And when we return, we will move on to computing the total cost variances. Until then, bye for now.